define the trend. We've talked about the market flow analysis method. We've also talked about upside mid-Kiltner penetrations and downside mid-Kiltner penetrations. So, let's define it. The first entry into the market flow and into the overall trend is this. So first entry, first pullback, okay? First entry into trend. We're going to define it as this, okay? You're going to utilize the Fibonacci retracements in conjunction with the Keltner channel bands. So if it's an uptrend, okay, market's trading up, market moves from low up to high, starts to come down, you're going to measure from low to high, do your 40, 50, and 60% retracements. And again, how do you know, back to the question, how do you know which Fibonacci retracement to enter the market? This is how I define and, determine where to enter the market. I'm going to use the Fibonacci retracements in conjunction with the Keltner channel bands. Okay? So remember how I said earlier, the Keltner channel bands, when you're in an uptrend, you're looking to enter the market when the market dips back between the mid to the lower Keltner. Mid to lower Keltner channel band is telling you, okay, so if this is the mid and this is the lower, the market's coming down off the high, I'm going to look to see which Fibonacci retracement is closest to sitting between the mid to the lower Keltner. That's how I determine where to enter the market. So let's just say the 50% retracement is the one fib that is closest to sitting between the mid to the lower. Remember, you do not want to be buying between the upper and mid. It's mid to lower is synonymous with support, which is synonymous with a potential buy. So I want to see which Fibonacci retracement is closest to right in there. So if the 40% is between the mid and the upper, and the 50% is slightly below the mid, and the 60% is closer to the lower outside of the lower, I'd pick the 50% retracement. If, for example, the 40% is at the mid-Keltner, and the 50 is at the lower, I'd go right in between, put my cursor right in between the 40 and the 50 and look to enter at the 45% retracement. That's how I determine how to enter on the first entry. First entry is fibs along with the Keltner channel bands, okay? Second entry into the trend, second entry into the overall trend, okay, is Fibonacci confluence. And we've already talked about that. Very simple, right? So it's Fibonacci confluence, right? Remember, you need two levels to measure. The reason we don't look to do Fibonacci confluence on the first pullback is because you've only got one level to measure, from low to high. There's not two to compare. So if the market does what we thought it would do, it dips between the mid and the lower, hits the 50, we're long there, okay? That's good. We're out somewhere here, and again, we're going to talk about trade management in a few minutes. So we're not getting into that. The market comes up, matches the high, takes it out. This becomes an active low, right? Active low number one. So now the market came up to high number two. Now it's coming down off of high number two, and we're looking for a second entry into the market flow. That's where fib confluence. We've talked about that. So now what we're going to do is the market starts coming down off that high. You're going to measure from high to the low and do your big set, right? The 40, 50, and 60, we'll say, of the bigger move. And we'll measure from active low to high number two, right? Let's say that's 40, 50, and 60. Let's say they're right on each other. 40, 50, and 60. Look at the 60 and the 40 are right on. That's Fibonacci confluence. That's another potential buy. That's how you look to enter on the second entry into the overall trend. Market flow in 79 and 89, right? All right, we've just talked about the first entry into the overall trend, second entry into the overall trend, Fibonacci confluence. Now let's talk about third, fourth, maybe fifth entries into the same trend, okay? Third, fourth, etc., right? Entries into the same trend. So it pretty much looks like this. First pullback, second pullback, okay, market comes up, okay? Market moves from low to high, pulls down, this becomes an active low once the sign's taken out. We've defined how we entered there from high to low. We used the fibs and the Keltner channel bands to determine our entry here. Then the market came up to high number two. Second pullback here, Fibonacci confluence, measuring from high 2 to low. Active low to high 2, measuring to see which are closest. Now third, fourth, or fifth. So now we're working on the third. Generally speaking, there are no entries on third, fourth, or fifth pullbacks because you get to a point of diminishing returns. I mean, the market can only go so far, so fast without reversing completely. But there are three exceptions. So generally there are no entries, okay? But there are three exceptions, okay? And those exceptions, let's put them down here for you. First exception would be if the market pulls back to the 79 simple and 89 exponential for the very first time in that uptrend, then that's a reason to take a trade on the third or fourth pullback, or whatever pullback it may be. So let's just say the market did not even come close to the moving averages in here. Okay? We'll just assume active low 1 and active low 2 are nowhere near the 79 and the 89, which are right here. But now the market pulls back down from high number 3, and of course that would be the third pullback in this example. If the market comes back and comes close to those moving averages, then I would obviously consider another entry into the market to the long side, since it's returning back to the average for the first time. So that's one exception. Moving averages. So it's back to MA's first time. So the first time in that trend, okay? The second exception would be what I call, and it's in the quick start manual, a move with conviction. A move with conviction is simply when the market makes a strong move up through the highest high in an uptrend or down through the lowest low in a downtrend in a relatively short period of time. Because what that's doing is it's telling me that there's a whole lot of momentum behind the market. So it's almost like reestablishing itself by just taking out that highest high. So let's just say the market busted up through this high in a relatively short period of time. Let's say if you're day trading the E-minis or the S&P, same thing really. If the market takes out that high by, let's say, 3 points or more to the upside, it happens in less than a half hour to an hour, and it really runs up there, then what I would do there would be I would look to enter the market the same way that I entered the first time, first entry into the trend. What I would do, though, is assuming this was a big move, so I'm going to call it a MVC, move with conviction, okay? And we've already defined that, and it's, again, the last manual you're going to read is the quick start manual, and that defines this, okay? So you get a move with conviction, it happens to be the third pullback. The way you're going to look to enter is you're going to measure from that last active low before that big move. You're going to measure from this low to this high, do your Fibonacci retracements, and you're going to utilize the Kiltner channel bands to see which fib level is the closest to sitting between the mid and the lower Kiltner. That's how you specifically determine where to enter the market, because again, the question, how do you know? Do I enter at the 40, 50, or 60? Use those Kiltner channel bands to help gauge where to enter. So the second exception is a move with conviction. Okay. Number 3 isn't in the comprehensive manual or quick start. Okay, but let me define it real quick. It's an extreme upside running pattern or an extreme downside running pattern in a downtrend. So it's an EURP, extreme upside running pattern in an uptrend, or an extreme downside running pattern in obviously a downtrend. And I'll define it real quick. It's real simple. You're going to look at the bars in relation to the Kiltner channel bands. An extreme upside running pattern is simply defined as 3 consecutive price bars that are trading at or above the upper Kiltner channel band, completely outside. So maybe the low of the bar, if you're day trading, let's say, is at the upper Kiltner, but just barely touching it, and the entire bar is outside of the upper Kiltner band, and you have 3 of those in a row that are outside, that's an extreme upside running pattern. Flip it over to a downtrend now. Market's making lower highs and lower lows, and the trend and the Kiltner channel bands are slanting down, right? If you get 3 consecutive price bars that are trading outside of the lower Kiltner channel band, that's defined as an extreme downside running pattern. In that particular case, you would be looking to enter between the mid to the lower Kiltner when buying in an uptrend automatically without using the fibs. In an extreme downside running pattern, you'd be looking to enter when the market rallies up off the low between the mid to the upper Kiltner without having to use the Fibonacci retracements. Those are the 3 exceptions to the rule on entering third, fourth, or fifth pullbacks in the same trend. All right. The 3 questions to always ask yourself whenever you're trading the market, I don't care if you're day trading the minis or the S&Ps or any other market, you need to ask yourself, first question, is the overall trend up or down? Simple as that, and I've already defined it. We've talked about the market flow, we've talked about the 79 and 89 exponential moving average with the mid-Kiltner crossing up through both, with the market flow being up, uptrend. Downtrend, market flow down, lower highs and lower lows, with the mid-Kiltner crossing down through both of the moving averages. simply ask yourself that question. Is the trend up or down? First question. Second question, which pullback and or retracement is it in that trend? All right? So obviously, if the market's in an uptrend and it's a first pullback, if you've already defined the question, you ask yourself, is the trend up or down? The trend is up. It's the first pullback. How do you enter? That's the third question. How do you enter? Well, if it's the first pullback and the trend is up, you enter based on here, Fibs and Kiltners. If it's a second pullback in the trend, Fibonacci confluence. If it's a third, fourth, or fifth pullback, you got to ask yourself, well, is one of the three exceptions that I just described met? If not, you're not looking to enter. If one of them are met, like the extreme upside or extreme downside running pattern or move with conviction, or if the market's returning back to the averages for the first time, then you've got a potential trade in that trend direction. So those are really the three questions you need to always ask yourself when you're sitting there watching the market. Another thing is, well, in the first question, okay, if you're not in a trend, are you testing the high or testing the low? If so, you need to refer back to the counter trend checklist that I described when I first started these videos and DVDs. So if you're testing the high or low, there's a potential counter trend trade setting up according to the criteria that I teach here in my course. Of course, if the market's in a trend, got to just, is it the first pullback? If it is, Fibs and Kiltners. If it's the second pullback, Fibonacci confluence. If it's a third pullback, you're generally not looking to enter. There are three exceptions. If one of them are being achieved, then you're looking to enter the market. It's as simple as that. What I'm going to talk about next is not in the comprehensive manual. It is discussed briefly in the quick start manual, but what I call it is trend analysis, a conflicting trend reading. You'll quickly understand what I mean when I start talking about it. Now, as you already know, there will be times when, let's say, the market flow changes trend direction according to how I define the market flow, and then the moving averages, i.e. the 79 and 89 exponential moving averages, will be pointing in an entirely different direction. This is what I mean. So by drawing a diagram here is going to show you exactly what I'm talking about and show you. Okay, let's say the trend is up, right? Market's making higher highs and higher active lows. And again, each one of these pullbacks, we're just assuming that they're defined as active lows. All the criteria have been met. Active low 1, active low 2, active low 3. This is the lowest low, right? High number 1, high number 2, high number 3, okay? Trend is obviously up, right? So let's just, according to the market flow, when the market takes out the most recent active low, which is the highest active low, according to the market flow, the trend is changed from up to down. Okay? So according to the market flow, if you're just trading the market flow with nothing else and you just use that analysis technique, that's fine, you can do that. But what I like to do is I like to sit back and say to myself, what's the overall trend? Obviously, if the market took out the most recent active low to the downside, and you were to look from the low of the day to the high of the day, or whatever chart, even if you're swing, short-term, or position trading a stock or any other market, the same principle applies. What's the overall trend? Look from this low to the highest high. Do your Fibonacci retracements from highest high to lowest low. Just by eyeballing this, I can tell you that this is probably the 40%, 50%, and about the 60% retracement. So the market breaks the most recent active low, but now you're entering the Fibonacci's of the bigger move. Now let's put one more thing here. What if the moving averages are here? And that's what I meant by conflicting signal. Look at this. The market flow has changed directions from up to down, but now you're coming back to the averages for the first time in the overall uptrend. So what I like to do is, the moving averages take precedence over the market flow changing directions by simply taking out the most recent active low in an uptrend. So in this case, even though the market has penetrated down through the most recent active low, if you're coming back to the averages for the very first time, I'd be looking to buy the market in here as opposed to looking to sell it on a pullback because this low was taken out. So that's what I mean there. So in order for you to switch your bias from uptrend to downtrend, I would absolutely need to see the market break down through both of the moving averages. So now you'd have the two criteria met. You broke through the most recent active low and the market has penetrated down through both of the moving averages. In this scenario, now I'd be looking to sell it on a pullback, right? And look for the trend to change from up to down. So if the market's not able to break it, you're back to the averages, you'd be looking to buy, right? You'd be looking for a bounce up at those averages. Plus the market's falling between the 40 and the 50% retracement of the overall uptrend. So that's what I mean by a conflicting trend reading. All right, we're still talking about trend analysis, a conflicting trend reading. I've just given you the example for an uptrend. Okay. Now I'm just going to draw the exact same picture, but for a downtrend. Okay. So let's just say we've been in a downtrend for quite a while. Okay. So again, the market moved from the highest high down to low number 1. This becomes active high number 1. So we just low 2, low 3, active high 2, active high 3. Right. Okay. Now the market rallies up and penetrates up through the most recent active high. Okay, now assuming the market's taken out the most recent active high to the upside, but now you're approaching the moving averages. That's conflicting, right? 79 and the 89. Because you're trading below the moving averages, but you've just taken out the most recent active high, which is the lowest active high in the downtrend, right? So according to the market flow analysis method, when the market penetrates up to the most recent active high, the trend has changed according to the market flow. But according to the moving averages, and if you do the Fibonacci retracements from high to the lowest low, the highest high to the lowest low, I can tell you right now, the 40% will be sitting here, the 50% and the 60% will be sitting there, right? So you got to sit back in your chair and say, what's my overall trend? Even though the market's taken out the most recent active high in the downtrend, my overall trend is still down. I mean, come on, the market's just approaching the 40 and 50% retracement from the big swing down, and you're approaching the moving averages for the very first time. Therefore, moving averages take precedence over the market flow, meaning I wouldn't be looking to buy it on a pullback because the most recent active high was taken out. Rather, I would be looking to sell the market, right? Between the 40 and 50% retracement of this down move back to the moving averages. Next thing we're going to talk about is time of day. So let's just say this is the afternoon, near 2 o'clock in the afternoon. Market trading up off the lows of the day in an overall downtrend. We're expecting some type of resumption back down towards the low of the day. There'd be 3 reasons to take a trade short, but again, I'm jumping ahead of myself a little bit, but just to get the point across, trend is down. Even though the market flow has changed direction to the upside, you're still trading below the moving averages. You're approaching the averages for the first time, and you're approaching the Fibonacci retracements of the overall trend of the downside. So definitely, the moving averages takes precedence in an example like this. This next section we're going to discuss now is perhaps one of the most important sections of the entire course, and I call it trade management. All right, like I just said, I can't even begin to explain how important this section is. Without knowing proper trade and or money management, it would be very difficult to make money in the markets. And since trading can be difficult as it is, once you make it more mechanical, once you enter the market, it'll make it much easier for you to not make any mistakes. All right. So there's 3 parts to trade management, all right? The first is the initial stop loss, and I abbreviate it as ISL, initial stop loss, which means when you first enter the market, you need to set a catastrophe stop. So if you're long the market, you need to absolutely set a sell stop to protect you in case the market continues going lower. Or if you're short the market, you need to put a buy stop to protect you in case the market goes against your position. So the initial stop loss we'll talk about first. Okay. The second section is basically pivot highs and pivot lows. Now let me explain this a little bit. What this does is it allows you, once you enter the market, by finding a pivot high or establishing a pivot high when you're short or a pivot low when you're long, that will allow you to move your initial stop loss up to below the pivot low when you're long, so you're risking less in the market. If you're short the market, you're going to be looking for a pivot high, so that'll allow you to move your initial stop loss lower, so you risk less on the trade. Okay, so really a pivot higher and a pivot low, that allows you to move your initial stop loss, so you're risking less on the trade. And then third is your profit taking. Okay, profit taking is very important. I mean, when you enter the market, you need to have a definable plan. I mean, when you enter the market, you need to know what you're risking, which is your initial stop loss. You need to have a plan of action to move your stop, so you're risking less than your catastrophe stop. And number 3, you need to know where you're going to take profits. If you don't know this before entering the market, then you're just going to be guessing. fear and greed will come in. You'll make more mistakes. And so you don't want that to happen. So I've got 3 very logical profit objectives, and I abbreviate as POs, profit objectives. All right, let's talk about the initial stop loss now. If you're going to be trading the E-minis, the E-mini S&P 500 or the full S&P 500 contract, my suggestion is to use an initial 3-point stop loss. Okay, now that's just a general rule of thumb. Okay, that's a good starting point. All right, 3-point stop loss. Another note is when trading the E-minis, you should always be entering on 25s or 75s and exiting, meaning taking profits and or stopping yourself out at 25s or 75s. You don't want to be around halves and rounds, 0.50s or 0.00s. You don't want to be on the round or the evens because floor traders tend to knock people out at those numbers, so you want to stick at the 25s and the 75s when entering or exiting the market. When trading the full S&P, if some of you are trading the full S&Ps, I'd be entering at like 90s, 10s, 40s, or 60s, staying away from the halves and the rounds again, okay? So a general rule of thumb, an initial 3-point stop loss, that's nice. But obviously as the market becomes more volatile or less volatile, you may want to change that a little bit, okay? So now what I'm going to go over are a few other things that you want to keep in mind when you are entering the trade. And these other things that I'm going to be talking about can be used on any market in any time frame, okay? So first thing you're going to want to look at when you enter the market, Keltner channel bands. If you're going long the market, let's say, okay, if you go long, okay, so you're above the moving averages and you're long the market, let's say, okay, and let's just say you're entering here. This is just a little illustration here, and this is, let's say, this is the mid Keltner, this is the lower Keltner band. Well, that wouldn't be right, obviously, because you're going to be entering minimum between mid and lower. You're never going to be wanting to enter between the upper or mid. When going long, like I talked about earlier, it's between the mid and the lower Keltner. So you obviously want to absolutely make sure that your initial stop loss is below the lower Keltner. Okay, so if you're entering long here, you want to obviously make sure that you're below the lower Keltner channel band. That's one thing you're going to look at. And again, I'm talking about long right now. If you're going short, the reverse is true. If you're going short between the mid to the upper Keltner as the market rallied up off of a low, and you're short it between the mid to the upper, you obviously want to make sure that your initial stop loss is above the upper Keltner band. That's number one. That's one thing you're going to look at. You also want to take a look at your Fibonacci retracements of the last swing. So let's say the market moved from this low up to this high, and you do your fibs. Let's say that's a 40, 50, and a 60. You want to take note of where your 60% retracement is. And you want to pretty much make sure that your initial stop loss is below the 60% retracement. So that's another thing you want to take a look at, are your fibs. Because again, when you're long, the Fibonacci retracement numbers act as potential support. So it wouldn't make sense to stop yourself out anywhere above the 60% retracement. We want to be below it. The third thing you kind of want to eyeball are the moving averages, the 79 to 89. Let's say the 79 simple moving average and 89 moving averages are sitting right here, right? So that's a support level. If you're entering anywhere near those moving averages, you absolutely want to make sure that your initial stop loss is placed below the lower moving average. Why on earth would you want to stop yourself out anywhere in between these moving averages or slightly above the first moving average? So, you're only going to utilize the 79 and 89 moving average as a potential initial stop loss if you're trading somewhere near them, or if your initial stop loss is anywhere near them. You just want to... So let's just say you're entering here and you're buying the mini S&Ps here, you subtract 3 points, and your initial stop loss comes to right here. Well, obviously you don't want to be stopping yourself out here. You're either going to adjust your initial stop loss lower so it's below the 89 moving average, or you're going to want to buy the market at a little lower price so you can try to keep your initial stop loss at 3 points. You don't want to be risking more than that if you're day trading the minis or the full S&Ps. Once again, if you swing short-term or position trade, then obviously this is going to be a bigger time frame. It's going to be bigger than a 3-minute chart like we currently use for the minis or the full S&Ps for day trading purposes. So those are the 3 things you really want to pay attention to. And again, if let's say you're entering the market and you're nowhere near the moving averages, then you're not going to look at those averages as a potential stop area. So let's just assume you're entering in here between the mid to the lower Keltner, 60% is right here, but but you notice that your moving averages are way down here. Well, you're not going to utilize them or take them into consideration when placing your initial stop loss. So the initial stop loss when trading the mini S&Ps or the full S&Ps, you're going to risk about 3 points, give or take some volatility, and these are the other things that you're going to look at. So again, you're going to want to enter on 25s or 75s, stay away from rounds or halves when trading the full or the minis rather. And on the full S&P, you want to be entering and exiting on like 90s, 40s, the 10s, and or 60s. Okay. And the other three things you're going to take a look at are the Kilner bands, right? When long, you absolutely want to make sure you're below the lower Kilner because you're most likely going to be buying it on the first pullback between the mid and the lower somewhere or the extreme upside or downside running pattern like we talked about earlier. So you're going to be eyeballing the Kilners. You're going to be looking at your fib levels, right? And then number three, you're also going to want to pay attention to your 79 and 89 exponential moving average. If you're anywhere near your averages when you're entering the market, you want to make sure that your initial stop loss is below the lower moving average when long or above the upper moving average when short. Okay, so when short, you want to try to put your initial stop loss above the 60% retracement in the downswing. In an uptrend, below the 60%. So you're looking at these three other things. And once again, that's not only valid for day trading purposes, the minis or the full, but it can be used on any market in any time frame. These principles are very important. So that covers the initial stop loss. Alright, let's talk about pivot highs and pivot lows now. This is the second section of trade management. Now this is where you're going to take your initial stop loss and move it so you're risking less than the initial. So a pivot high is going to be used when you're going short. So let's just say you go short the market here. You're going to wait for a pivot high to be put in place. So let's just say you go short there. Your initial stop loss is somewhere up in here. Okay? So a pivot high is the point in which the market goes against your initial trade. So in this case, it goes against your short sale. So, okay, it starts to move down. Okay? Let's define what a pivot high is, though. Okay, this is nothing yet. You've got two criteria that the market must meet in order for this to become a pivot high in which you would move your initial stop loss down to above it. So you're up here, your initial stop loss way up in here, let's say. Market moves against your trade. Two criteria. The one is the market must come back down. Well, it's a time and a price element. Let's go over time first. Time, you need at least 2 bars to the right of the high bar. So this is the high bar, obviously, right? That's the high bar. You need 2 bars to the right of that high bar with lower highs and lower lows. So that's 1, that's 2, right? 2 bars to the right up. Lower highs and lower lows. That's one of the things that you need. 2 is the market must come down far enough below that high to consider it a large enough pullback to say, okay, that's a pivot high. So I'm not going to give it a point value here because if I give it a point value, then things change over time just because of volatility. The same concept applies. So what I'm going to do is I'm going to interject the Kilner channel bands here. So since you're going short the market, chances are you're always going to be, when you're selling the market on a pullback, you're always selling the market above the mid Kilner, somewhere between the mid to the upper Kilner, or a lot of times even above the upper Kilner to retracement, maybe back to the moving averages. So what you want to see is you want to see the market fall back into between the mid to lower Kilner. See, the market's in a downtrend, the Kilner bands are going to be slanting down. Upper, mid, low are going to be going down in price. When the market starts to turn up from this low and go up, the Kilners are going to be slanting up. So when you're shorting it, I can guarantee you that the mid Kilner will be somewhere down in here, mid to lower Kilner. So you want to see the market at least touch the mid and maybe go between the mid to lower Kilner. That would tell you that it's a large enough pullback. So it's time and price. The price element is the market for a pivot high to be established. The market needs to come back down and drop between the mid and the lower. In time, you need at least 2 bars to the right with lower highs and lower lows. Once you have these 2 criteria met, that then becomes a pivot high, at which point you would take your initial stop loss and move it down to above the pivot high. And once you do that, you're obviously risking less. So let's just assume you're day trading the mini S&Ps. You short there, you add 3 points up to this point, okay? And once you move your stop down, a majority of the time you're going to be risking anywhere from half to 2/3 of what your initial risk was. And that goes for any market, any time frame, not just the minis or the full S&Ps. And let me just go this far. With whatever losses you have, 80% of your losses, you will in fact be able to move your initial stop loss, so you're risking less. So that covers pivot high. Pivot low is the same thing, but the reverse. You're going long. So let's just say the trend is up, right? Market pulls down, and you go long here, which is obviously synonymous with you bought the market here. Market goes against your, okay, let's assume your initial stop loss is down here. Okay? Initial stop loss is down in here. Okay, it's a point which it goes against your trade. You need to see at least 2 bars to the right, so you need time element, 2 bars with higher highs. This time, higher highs and higher lows. So let's just say you get 1, 2. Okay, 1, 2. Higher highs and higher lows from the low bar, right? And as long as the market rallied up to at least between the mid to the upper Keltner, remember this was mid to lower Keltner because you're going short, now it's mid to upper. If the market is able to rally between the mid to the upper Keltner band, then it's a big enough movement up off this low to consider this a pivot low. So you have a time element and you have a price element. Again, price being mid to upper Keltner, time being at least 2 bars to the right with higher highs and higher lows. Once you have this met, that officially becomes a pivot low, in which point you take your initial stop loss and move it up to right below that low. And again, you never want to stop yourself out at rounds or halves. Okay, so you want to, it'd be at 75s or 25s. Okay, so that really covers the pivot highs and the pivot lows. So now we've talked about the initial stop loss, pivot highs and pivot lows, so you risk less. All right, let's talk about the profit objectives now. All right, the first profit objective is only valid for trading the E-minis or the full S&P contract. And this is just based on years of experience and based on what I'm teaching you in terms of entry, trade strategies, everything. It's an automatic, just an automatic 2 points from wherever you enter the market. So if you're going long, simply add 2 points from your entry. If you're short, you simply add 2 points from your short entry. It's as simple as that. Once again, PO1, profit objective number 1, is only valid for trading the E-minis or the full S&P contracts. Now P2 and P3 are not only valid for trading the E-minis and the full S&Ps, but really any market, any time frame that you decide to trade. Okay, P2 is very simple. Okay, I think it'd be best for me to draw an example to show you, because basically it's simply P2 is a profit objective based on entering the market on a pullback and or a Fibonacci retracement. Okay, so let's do a buy example first. All right, so the market moves from this low up to this high, and you go long the market. Okay, you buy it here. The profit objective is really volatility based, because depending on how far it pulls down off the high, it gives you the profit objective. All it is a 50% retracement back from the high. So the formula is simple. You take the high that the market came down off of, minus your entry price, divided by 2, get that number and add it back to your entry. Okay, I mean, it's as simple as that. All right, so if you're buying the market, you're going to take the high that it came, get the actual value of the market it came down from, right, the price, subtract that down from your entry price, right, that gives you the range from high to where you entered, divide it by 2, and then add it back. So it's really the 50% from where you entered to high back. So you're betting on the fact when you buy the market here, you're anticipating a minimum of the market coming back to the 50%. And that's volatility based, because obviously the more volatile the market is, the bigger this number will be, because of the bigger swing. The less volatile, the less you're looking for. Okay? Now let's just talk about a sell. You'll flip the equation. So you're in a downtrend, right? The market moved from high down to low, right? So what you're going to do is you're going to take your sell entry, right? Your sell minus the low that it came up off of, right? Sell minus low divided by 2. Get that number and subtract it back down to your the low, right? So it's a 50%er again. So from wherever you entered, so it's sell minus low divided by 2. Take that number and subtract it down from your entry. That's your P2. So really the 50% back is your P2, PO2. 50% here is, what do I say, PO2, okay? And now your third profit objective, real simple. It's simply, when you're long the market, it's a couple movements, a couple ticks, right? Price fluctuation is what I call a tick. So in the mini S&Ps, it trades in 25-cent increments, right? 25, 50, 75 round. Full S&Ps, 10 cent, 10, 20, 30, 40 cent increments. So if this high is, let's say, 1365, let's say, one tick down from there would be 1364 and 3/4. That's P3. So P3 on a buy, when you're buying the market, P3 is simply a tick or two down from the high. When selling the market, P3 is simply a couple of ticks up from the low. So think about this. You've already learned the market flow, the Fibonacci retracement, and what you're expecting for the market to do somewhere between the 40, 50, and 60% retracements of this move, right? You're expecting you wouldn't be buying the market here if you didn't think the market would bounce back up and at least test the high. Well, if the market does do that, then both profit objectives will be hit, right? P2 and P3, and then, let's say P1 will be somewhere here, right? Let's say P1 will be here. But a lot of times, when day trading the minis or the full S&Ps, P1 and P2 will be the same price. What I like to do is always take the smallest. So before you enter the trade, my suggestion is to know all these numbers, because you're going to know what your entry is before you enter the market. So take your entry, get your stop loss. You'll have that. You write that down. Calculate P1, P2, and P3. I look at those numbers. Take the smallest profit objective. If you trade multiple contracts, take 3/4 of your trade off at the smallest profit objective, and then whatever you feel most comfortable with the remainder part of your position. Okay. So that's P3, real simple. Now, trailing stop. Let me give you one trailing stop, okay? So if you're one of those types of people that are looking for the bigger move in the market, a trailing stop is simply moving your stop so you lock in profits as the market's moving in your favor. So let's just take the long here. Again, remember, a pivot low becomes a pivot high. A pivot low becomes a pivot. A pivot low becomes an active low remember, a pivot low occurs first. And then if the market comes back up and tests this high, it becomes an active low, right? Same thing here. A pivot high turns into an active high if the market does what you thought it would do. Come back down, hit P3, and hit this low, okay? So for a trailing stop, my suggestion is whatever time frame that you use to enter the market, once the market hits this high or comes close to the high and you're still long and you've got a position on, or you're short and the market's close to this low, as soon as that occurs, flip to one time frame smaller than the time frame you used to enter the market. So if you're day trading the mini S&Ps on a 3-minute chart, as soon as the market hits this high, flip to a 1-minute Kiltner channel band and look to trail your stop up to just below the lower Kiltner band. Because as you know, once the market comes up and hits this high, those Kiltners will be up. And the reason I like to use one time frame smaller than the time frame you used to enter the market, like you do on a 3 when day trading, you're going to be locking in profits a whole lot quicker. So you're not even going to be thinking about trailing up a stop until the market can come closer, hit, and or penetrate up through this high. Same thing here, hit this low. Then you'll look to trail your stop. If, in fact, that's your personality and temperament to utilize a trailing stop. But my suggestion, if you're day trading, is to flip to a 1-minute Kiltner channel band. When you're long, move it up to below the lower Kiltner band. If you're short, move your buy stop down to just above the upper Kiltner band. Alright, what we're going to talk about next is time of day. Okay, time of day. Now this is only good for those of you that are planning on day trading. Whether it be the mini S&Ps or stocks or the full S&Ps, it really doesn't matter. Stock index futures. But for those that are just swing trading, short-term or position trading, obviously time of day has no relevance to you. Remember, this is a general timetable and or roadmap of what to expect during the trading day. It's real easy to understand. Don't make it any more difficult than it is, because it really is very simple. And just remember, this is not a standalone trade strategy. It just gives you an idea of what to expect during the day. You still need a technical charting reason for taking a trade, like the market flow, the moving averages, Fibonacci retracements, everything that we've talked about up to this point. You need to take a trade. Time of day is just gives you a general idea of what to expect. All right. The best and most predictable times of the day, in my opinion, are definitely from 1:15 to 3:15 Eastern Standard Time. The least predictable time of the day, by far, I think, is from, the opening, 9:30 a.m. Eastern Standard Time to about 10:15. The second most predictable time of the day, in my opinion, about 10:30 to 11:30 Eastern Standard Time. Obviously, the least volatile time of the day, lunchtime, 12 to 1 Eastern Standard Time. And the last hour, you can trade in the last hour, but my suggestion is, kind of gets hectic. So my suggestion is not to trade, but it's really up to you. All right. So the times we're going to be discussing are the 10:30 a.m. Eastern Standard Time. Remember, all these times that I'm giving you, there's really about 4 general times. To 10:30 a.m. Eastern, 1:15 to 2, 2 o'clock, and 3 o'clock. These are all Eastern Standard Times. All right. Give or take 15 minutes. Nothing's perfect. Okay. So at 10:30, you're simply looking for some type of counter trend move of the first hour's trend, if there is one. So for example, the market opens up and does something like this, comes down, and it's in and around 10:30 in the morning, right in this area, in and around 10:30, give or take 15 minutes, you would generally expect some type of counter trend move to the upside. Simple as that. If the market's trading here and it's near 10:30, you're not looking for anything. Because again, the market's not on the high of the day, nor is it on the low of the day if it's sitting here. But if it is at the low, or it is testing the high of the day, and the overall bias or trend of the day is near the high, you'd expect the counter trend move to the downside. If it's near the low, expect some type of move to the upside. It's that simple. All right, the 3 other times that we're kind of paying attention to is the post-lunch move between about 1:15 to 2 o'clock Eastern Standard Time, the 2 o'clock and or 3 o'clock. So this diagram quickly illustrates, so in an uptrend, we're assuming that's an uptrend, right? Market moved from this low to this high, the overall bias of the day has been up. Come back from lunch, you notice that the market's trading down off the highs of the day, and it's in an area where you'd be looking to buy the market, i.e. maybe between a 40 and a 50% retracement from the low of the day to the high of the day. Maybe you're back near or at your moving averages, 79 to 89, and it happens to be between 1 and 2 o'clock, trading down off the highs of the day. You would be expecting some type of resumption back up towards the high of the day, okay? Now I drew this up in here to show you, well, what if it's 1 to 2 here? What if it's 2 or 3 and you're near the highs of the day? Well, you obviously can't expect a resumption of the day's trend if the market's already sitting on the high of the day. So that could be 2 or 3 o'clock. It doesn't really matter. Wherever it is, you just have to ask yourself, where's the market and what time is it? Oh, it's 2 o'clock. Okay, it's near the high of the day. Well, I can only be expecting a potential counter trend trade to the downside. If it's down off the highs of the day, I'd be expecting some type of bounce up towards the highs. So it all really depends on where the market is at the particular time. And in this example, it's just like this one, but the difference is it's a downtrend. Market's in a downtrend, come back from lunch, market's trading up off the lows of the day, and it's sitting in an area where you'd be expecting maybe some type of resumption because it's time between 1:15 and 2, sitting near your moving averages, Fibonacci retracement from high to low. It's in an area where you would be expecting some type of resumption back down towards the low of the day. Well, what if it's 2 o'clock and it's near the lows of the day where you'd be expecting a counter trend move to the upside? 2 or 3, it doesn't matter. Wherever the market is at that particular time dictates what you would be expecting. Now, just because the market's sitting at the high of the day near 2 or 3 o'clock, whatever time it may be, doesn't mean the market can't continue going higher. Of course it can. But we're expecting a potential counter trend if it sets up according to the criteria that I'm showing you here in my course. So refer back to the counter trend checklist, which is not only in the quick start manual, but earlier on the tapes when I first started out these videos and DVDs. That concludes the time of day section. It's that simple. Don't make it any more difficult than it is because it really is very simplistic. Simple. 10:30 in the morning, if the market's been trending the first hour, there's some type of bias, and it's setting up according to the counter trend strategy that I talked about earlier, expect some type of counter trend move. Right after lunch, between 1:15 and 2, if the market's been trending up all day and it's down off the highs at a technical level to look to go long, expect some type of resumption back up towards the highs. If it's near the highs of the day, near 2 or 3 o'clock, let's say, be expecting a counter trend. It's as simple as that. And when you do get that afternoon counter trend move down off the highs of the day in an overall uptrend, be expecting a minimum of a 40% retracement of the entire day's up move. Same thing to the downside. Now what we're going to discuss is coming into a fresh new trading day, 9:30 a.m. Eastern Standard Time. Once again, this is only valid for those of you that are planning
Okay.
on day trading either the mini S&Ps, full S&Ps, stocks, or whatever.
Yeah, no problem.
If you're not going to day trade, this obviously has no relevance to you. But if you are a day trader, this is what you want to be aware of. You can start the market flow fresh each day. The trend development that we talked about earlier, the market flow analysis method, in conjunction with the 79 simple and the 89 exponential, the upside, the downside, mid-Kiltner penetrations to determine the day's trend. You can start it fresh each day, and or you can continue it from the prior day. Obviously, the prior day, I mean, each day is pretty much independent from the prior day in terms of overall action, but a good rule of thumb is you want to utilize both. You want to start the market flow and the overall trend fresh each day, but you also want to utilize that in conjunction with the prior day's trend. So let's say yesterday was a pretty big down day, let's say, and the market closes in the bottom quarter or third. You obviously want to take that information and utilize it at your, when the market opens. So what you're going to do, my suggestion and a good rule of thumb, is the first hour to hour and a half of every single day, which means 9:30 a.m. Eastern to about 10:30 to 11 o'clock, you are in fact utilizing the prior day's action as well in terms of highs and lows, support and resistance. So if it was a downtrend yesterday, you're going to calculate from the prior day's high to today's intraday low, calculate those, and know where your moving averages are on your intraday charts too. Okay, so you want to use a combination of starting the trend fresh each day in conjunction with the prior day's trend. And what's real important is that first hour to hour and a half, you are in fact utilizing the prior day's criteria for figuring out support and resistance, which is the synonymous with buying or selling at critical levels in the market. All right, these two charts that I have up in here are perfect examples of openings on the current day. So we are utilizing the prior day, so we're going to assume that this is the prior day, opens up right here. So what we're going to do is we're just waiting for the market. Like an example like this, that's a pretty nice downtrend from the prior day. It opens up kind of unchanged, maybe slightly higher. We're going to first, IL stands for an intraday low. So you're waiting for an intraday low to be put in place for the market just to rally up into some type of resistance, which is synonymous with potential sells carried over from the prior day. So as soon as the market makes an intraday low here and starts to rally up, we're going to take that intraday low. We're going to do our Fibonacci retracements from the prior day's high to the intraday low, 40, 50, and 60 from high to low. And look at, these are falling near your moving averages, which is another reason to look to sell the market. So the market opens up, kind of comes down a little bit, comes back up, rallies into an area where you're looking to sell. So that's a good example of utilizing the prior day in with today to come up with a trade in the morning. Second example down here is very similar, opens up unchanged, but the difference is the market's not able to rally high enough to get you in. If you were looking to sell it in here, closer to your averages, closer to between the 40 and the 50 from the high to low, you missed the trade. Okay, no big deal. So now the market turns, you don't get in, the market comes down and takes out the prior day's low, the low of the prior day, which I label as L3. As soon as the market comes down and takes out the high, or rather the low of the prior day, you're just waiting for the market to put in a low. Hits the low, starts to come up off that low. Now this is an example of using the current day to enter the market. Okay? So now you're going to do, as soon as the market starts coming up off that low, you're going to measure from the low to high, do your self-Fibonacci retracement. Oh, Rob, that's a mistake. Basically, I'm going to take, since the market was not able to rally up and get you in, and the market fell short, and then it came back down and took out the low of the prior day, now what you're going to use is the current day for your fibs and your Kiltners and everything else that I've shown you. So you're going to measure from high to the low of today, disregarding yesterday. High to low, 40, 50, and 60% retracement. Okay, the market flow has established itself to be down because it took out the low of the prior day, and you've got a large enough initial range in place here, we're assuming. Okay, high to low, do your fibs. Ask yourself, is it trend up or down? Trend is down. Okay, trend is down. How do you enter? Okay, is it the first or second pullback in the trend? Obviously, this is the first pullback. Okay, how do you enter on first pullback of the trend? If you remember back, use your Fibonacci retracements from high to low in conjunction with the Kiltner channel band. So in this example, mid to upper Kiltner. Which Fibonacci is closest to sitting between the mid to the upper? That's where you're looking to sell the market, somewhere between the 40 and 60% retracement. You're looking for a reaction back down. All right, these last two charts are just two other examples, obviously, of the market opening each day and how you treat the opening and what you're looking for specifically to look for the trend to develop. And obviously there's tons of different scenarios. These last two out of the four that I've given you in this section is just probably the most common. So in this one, really just the opposite of whatever the last two charts that I showed you were pretty much downtrends and then opening unchanged, maybe slightly higher. These are just the opposite, uptrends. So in this case, obviously the prior day, it was an uptrend, opened up lower, okay? So, I mean, if this is close enough to the moving averages where you can look to be buying the market and stick your stop below the lower moving average, you could be looking to buy it here as long as it's at the 50% retracement from high 3 to low or higher. Then you could be looking to buy, looking for the resumption back up to the close and potentially the high. You could have that, or if you're waiting for the market to come up and break through the high and establish the trend today, disregarding yesterday, you could wait for that. But as you see here, this pretty much is a retest failure. The market came up, tested the prior day's high, which I labeled as high 3. It failed, came back down. Now it's up to you whether or not, I would not be looking to buy it in here because the market was not able to penetrate up through the prior day's high, which would tell me that it's probably going to continue the uptrend if it took it out. But in this case, it didn't. So the question is, you're not going to be buying based on retracements from high to low because it did not take out the high. If it comes down to the moving averages, I probably wouldn't be looking to buy it either because now the market's retraced more than 60% from the low of the day up to the high, telling me it's probably going to go lower. But in fact, you may get a bounce. I'm not sure. It just depends on what your comfort level is on looking for a bounce here. You could try it, but I think the probability is favored that you're probably going to try to break down through the moving averages. So if that's the case, then the trend has changed. The market broke down through the averages and the mid-Kiltner crossed down through both of the moving averages. Not only that, but it took out the low of the day. So the trend of the day is obviously down now. Okay? So now I'd be looking to sell on a retracement from high to the day's new low. Do your fibs, 40, 50, 60. Back to the moving averages, be looking to sell it in here, looking for something like this to happen. In this example here, the market opened up lower, came closer to the moving averages. You could have been looking to buy it there, looking for the bounce up off those moving averages. After all, you are trading in the direction of the overall trend from the prior day. That makes sense. Now, once the market penetrated up through the prior day's high, that just further confirms that today is now an uptrend according to the market flow. You're not only trading above both the moving averages, but the market flow just changed. Not changed, but it continued up because it took out the prior day's high. That being the case, as soon as it hits the high and starts coming down off it, you're going to measure from the high to the low of the day and do your fibs, 40, 50, and 60% retracement from the low of the day to the high of the day. Be looking to buy somewhere in here. And if it's the first pullback in the market flow, do your fibs, look at the fib retracements in conjunction with the mid to lower Kiltner channel band since you're looking to buy, to see which Fibonacci retracement is closest to being between the mid and the lower, and you'd be looking to buy here. And that really concludes, the four examples that I wanted to show you coming fresh into each day. Alright, that concludes the first video or DVD. The next video or DVD will be actual live chart examples showing you exact trade setups based on everything that you've already learned.